If inflation keeps going up and the Fed doesn't hike, that means real interest rates are going down a lot more than people think. So this policy is going to be bad for the dollar, and it's going to be bullish for gold. Higher inflation that the Fed can't fight is bullish for gold. The only time higher inflation is bad for gold is if you think the Fed's going to successfully fight it with interest rates high enough to actually bring it down and give you a high positive real rate, which would make gold less attractive. But that's not going to happen. The Fed's not going to hike rates in line with the increase in inflation. Real yields are going to fall, and and gold.
Good evening, and welcome to Financial Insights Tonight, where we break down the latest news shaping markets and your investments. In today's spotlight, renowned economist and investor Peter Schiff delivers urgent insights on inflation, Federal Reserve policy, and their game-changing impact on gold and silver. Investors, get ready. This analysis could reshape your portfolio strategy. Let's start with the week's performance in precious metals. Gold has faced headwinds, dropping 2.3% to $2,570, falling below the critical $2,600 threshold. Despite bouncing back from recent lows, the stronger U.S. dollar and Federal Reserve uncertainty have kept the metal under pressure. Silver, meanwhile, has shown resilience, closing the week at $30.35, a modest decline of 1.4%. Schiff highlights silver stability, noting its key role in navigating volatile markets. Now, here's where Schiff's analysis gets compelling. The Federal Reserve's monetary policy, or lack thereof, is shaping a perfect storm for inflation and precious metals. Schiff argues that the Fed is unlikely to hike interest rates aggressively, even as inflation rises. This leads to declining real interest rates, a historically bullish condition for gold. He emphasizes that higher inflation, coupled with the Fed's limited tools to combat it, is a recipe for gold prices to climb higher.
2.3% on the week, continuing its post-Trump pullback, going below 2,600. Silver was down 1.4% on the week. Silver has been holding up better than gold during this sell-off, and it has been holding the $30. It did briefly trade below it, but it closed the week at about $30.18. Remember, I said that I thought $30 silver was like $2,000 gold, and I think that's kind of the support. And it certainly is looking like it because it's holding up with the gold sell-off. Of course, fool's gold, aka Bitcoin, went in the opposite direction. Bitcoin, I'm looking at the Bitcoin ETFs. They were up about 11% on the week. Bitcoin itself is trading above 90,000. In fact, I think it's above 91,000, almost 92,000. So this is record territory. Not yet record territory in gold terms, I don't think. I gotta do the math. Maybe I'll do that on the commercial break. But MicroStrategy up 13.5% on the week, continues to borrow money to buy Bitcoin. But look, Senator Loomis came out and she's introducing, her bill for the U.S. government to buy Bitcoin, 1 million Bitcoin, and pay for it by selling gold. I mean, what an asinine trade to make on behalf of the American public. I mean, if this actually ever happened, if this bill was actually passed and signed into law, and the U.S. Treasury was actually dumb enough to sell off America's gold to buy 1 million Bitcoin. First of all, the Fed may not cut rates as much as the market expected. But the one thing they're not going to do is hike them. Powell is not going to surprise the markets by hiking interest rates. Right? And imagine the reaction of Trump, too, if he did start hiking rates. But they're not going to do it, especially if the economic data starts to get worse, which it probably will, because I think they were hiding a lot of bad data, trying to make the economy look better to help elect Harris. And so now that Trump's in fact, once he becomes in, and say, hey, let's dump some bad data out here to really, to make, why are we, trying to whitewash the economy when we got Trump? So the Fed is going to be looking at weakening economic data and rising inflation at the same time. And remember, I went over on last week's podcast, the Fed has no plan for stagflation. We get a weakening economy and rising inflation, the Fed's got nothing. Right? They're shooting blank. But the one thing I know they're not going to do is fight inflation in a weak economy, because that's political suicide. So it's not going to happen. So that's not good for the dollar. It's bad for the dollar that we're going to have an accommodative Fed and falling real interest rates. Because if inflation keeps going up and the Fed doesn't hike, that means real interest rates are going down a lot more than people think. So this policy is going to be bad for the dollar, and it's going to be bullish for gold. Higher inflation that the Fed can't fight is bullish for gold. The only time higher inflation is bad for gold is if you think the Fed's going to successfully fight it with interest rates high enough to actually bring it down and give you a high positive real rate, which would make gold less attractive. But that's not going to happen. The Fed's not going to hike rates in line with the increase in inflation. Real yields are going to fall and gold's going to go up. You know, it's interesting that Bitcoin and gold are going in the opposite direction, right? Bitcoin's been going straight up ever since Trump won, and gold's been going straight down. Again, I've said this. Bitcoin is the anti-gold. It's not digital gold because it does the opposite of whatever gold does, because it's nothing like gold.
Welcome to Economy Express, your go-to destination for all things economics and finance. Whether you're an experienced investor, an inquisitive student, or just someone who wants to stay ahead in today's ever-changing economic landscape, you've come to the right place. Now, let's get into the details of our news.
Treasury closed at 4.44. That's the highest it's been since Trump was elected. 30-year yields, people don't talk about those as much, but we're at 4.62. So we're now closer to 5% than 4%. You know, we were below 4 when the Fed cut rates by 50 basis points. What was that, just September? In fact, the Fed has now cut rates by 75 basis points, the Fed funds rate. The 10-year Treasury is up 75 basis points the other direction. So it's a 150 basis point swing between the Fed funds and the 10-year Treasury. This is the opposite of what the Fed had hoped. The purpose of the rate cuts was to bring down longer-term rates too. They wanted relief to the housing market. They wanted to make buying homes cheaper, so they wanted mortgage rates to come down. The markets had believed that cutting rates would be good for the long end. After all, that's what happened with all the other rate cuts when the Fed kept cutting rates. In fact, when it went to zero during COVID, right, rates in the long end went to below 1%. Of course, the Fed was doing quantitative easing at the time. Now they're still doing quantitative tightening. In fact, I think the balance sheet just slipped below $7 trillion for the first time since they started doing quantitative tightening. But as I've been saying, without the Fed doing quantitative easing, long rates are going to keep rising. We're not even close to the end of this as the yield curve normalizes and actually ends up being steeper than normal due to the inflation trajectory. The Federal Reserve is likely unconstitutional, is because the government tried to get around the Constitution by creating the Fed. Saying, oh, look, we're not doing it, right? The Fed is doing it. They're totally independent. Well, BS, they're not totally independent. They're really beholden. The reason the Fed has to be independent is not because the guys that drafted the Federal Reserve Act thought, hey, it's a good idea to have an independent Federal Reserve. Like it's better for policy as a check on the government. No, it had to be independent because if it wasn't independent, the whole thing was unconstitutional. That is the reason it would be unconstitutional for Congress to do it. But I think it's unconstitutional to do it indirectly. And of course, when the Federal Reserve Act was upheld as constitutional, it was when Federal Reserve notes were real notes, obligations of the Federal Reserve to pay lawful money, gold and silver coin minted by the U.S. government. So initially, they were legitimate, but now they're irredeemable. So there's never been a court that has held that irredeemable notes issued by a private banking syndicate during peacetime are constitutional. Now, I don't think any judge 100 years ago would have ruled it that way. Who knows what the justices would do now? But I just thought it was ironic that they're saying, oh, no, the Federal Reserve is unconstitutional. Let's let the government do it. No, if the government did it, then it would really be unconstitutional. It's much better to have the Fed. And yes, it is better to have some independence, even if it's just a veneer, right? I mean, a little bit. We need to get rid of the Fed, which is, end the Fed. Let's get rid of the Fed. But what they're saying is, let's get rid of the Fed and let's let the government do the Fed's job. I don't know if they mean Congress or the executive. They probably mean the Treasury, right? They're saying that, the Federal Reserve is unconstitutional, right? It's a private banking syndicate. Why are they in charge of our money? That can't be constitutional. We should have the government do it. Let's get rid of the Fed and let's let Donald Trump decide what interest rates should be.
For financial investors, this insight underscores the importance of physical gold as a hedge against the weakening dollar and inflationary pressures. But it's not just gold making waves. Schiff sheds light on the contrasting trajectories of Bitcoin and gold. Bitcoin continues to soar, with prices nearing record highs, while gold struggles. Schiff dismisses Bitcoin as anti-gold, arguing it lacks the intrinsic value of precious metals and thrives on speculative trends. He also critiques proposals like Senator Lummis's suggestion for the U.S. government to sell gold and purchase Bitcoin, calling it an asinine trade that would destabilize the economy further. For crypto investors, Schiff's skepticism raises critical questions about the long-term sustainability of digital assets compared to traditional inflation hedges. Shifting focus to the bond market, Schiff warns of a steepening yield curve, driven by rising inflation and ballooning national debt. Treasury yields continue to climb, with the 10-year reaching 4.44% and the 30-year at 4.62%. These movements, coupled with the Fed's ongoing quantitative tightening, point to an economic slowdown. Schiff highlights that the Fed's recent rate cuts, meant to ease long-term rates, have had the opposite effect, pushing yields higher and adding pressure to the housing and credit markets. For portfolio managers and fixed-income investors, this signals increased risk in long-term bonds and a need to reevaluate exposure to interest rate-sensitive assets. Finally, Schiff critiques the Federal Reserve itself, questioning its constitutionality and independence. He argues that the Fed's creation was designed to skirt constitutional limits on money issuance, and its policies have increasingly failed to stabilize the economy. Schiff's call to end the Fed resonates with those advocating for systemic reform in monetary policy. So, what's the takeaway for investors? Schiff paints a clear picture. Inflation is rising, real interest rates are falling, and gold and silver remain the ultimate safe havens. In a landscape marked by uncertainty, these precious metals are more than just a hedge, they're a financial lifeline. This has been Financial Insights Tonight. Stay informed, stay prepared, and join us tomorrow for more actionable analysis. Good night.